Hey everyone, hope you're doing well today. This is Drew Creekmer, and I'm joined today by John Creekmer, our Senior Wealth Advisor and Founder. And today we're going to be doing a deep dive. We are about a third of the way through the year, and so we think it's time to level set where we're at, recap what's happened so far this year, and what we're doing to make sure that we are in the best position possible to move forward with the period in time we are at. But before we do that, John, how are you doing today?
Hey, doing great, and it's kind of nice to see the changing of seasons. I've always enjoyed whenever we go from one season to the next. It doesn't really matter what season it's in, but just to see that, and it kind of makes me want to get out more and do more work on the yard and stuff like that. So I'm not hurting too bad from last weekend. I'm sure that comes shortly, but
Yeah, there you go.
but I just totally love this time of year.
Yeah. Are you planting tomatoes this year?
I think I am. I actually have a fence set up around the blueberry bush. The rabbits got to the blueberries last year, so that was kind of heartbreaking.
No.
But we'll probably do tomatoes and cucumbers for sure at the end of May.
Well, there you go. It's always nice to have some fresh stuff to go out and pick and eat, and so that's awesome.
Right?
Hey, let's talk about a major event that we did
Mm.
down in Central Illinois. We broadcast it as well. It's one of the best events I think we've ever done here at Creekmore Wealth, and we will include a link to the full recording of that video. There's a ton of great and relevant information from the Truth Live. John, can you just kind of recap for us
Yeah.
what that event was about and some of the things that we covered there?
One of the things we always focus on is called E cubed. And so with everyone, with everything we put out there, so whether it's deep dive or whether it's different events or whatever, we want to be in one of three E's, either educate, empower, or encourage. And so as an example, whenever we have an event that we encourage everyone to bring your kids and grandkids out to a movie. That's part of the encouragement as far as the family values and spending time together. Well, this last event we had was called The Truth, and that goes into education. And we partnered with First Trust Portfolios. They're a large money management firm based in Chicagoland area, and their economics team and research team is highly regarded as one of the most accurate predictors of economic events and changing items, and also politically. Phenomenal predictor as far as politics and elections. And so we had one of their key economic researchers, Andrew Opdyke, into East Peoria, and we had a phenomenal event that evening, and we kind of walked through just about what is true and how we have to focus upon truth in order to make wise decisions regarding our finances. And so things about trying to look at the media and information and trying to figure out what does the different things that are happening, and if all we look at is what is being peddled, I guess, by the media industry, we don't have the complete truth. And so Andrew did a phenomenal job of just laying out numbers and educating everyone there about inflation, educating what is inflation and monetary supply. And we just had so much phenomenal feedback of that event that Drew, I think we've decided to actually roll that out as far as on our video channels and for everyone to get a copy of that. And so if you want to talk about how they can find that, that'd be great.
Yeah, absolutely. So we'll include a link in the bio of this email where you can click on that link. It'll take you right to the full recording to access. You can also find it on our YouTube channel as well. And so we'll also include a link to our YouTube channel where you can find all of the videos that we've made over the last couple of years. We've been working on getting those up and indexed in YouTube as well. So definitely check that out and subscribe if you want to be a YouTube user. And so that's how you can find the Truth Live recording. And so John, let's kind of dive into some more recent look back of what's happened over the last 4 months. And we're going to put a chart up here on the screen that walks through performance year to date for four major stock market indices. Purple line, that is the S&P 500. The blue line, that is the U.S. aggregate bond index, so all of the bonds publicly traded here in the United States. The green line is the Dow Jones, and the orange line is the NASDAQ. And so, as we can see, the majority of the stock indexes are off by roughly 10+% year to date. And what is a little abnormal with stock market indexes down so far this year is that bonds are also down in line with stock market indices. Typically, that does not happen. Typically, stocks go down, bonds go up, or stay flat. And so what we are seeing is a really unique reverberation from all of the economic activity that's happened in the last 2 years. And so, John, when you look at this chart, what stands out to you, if anything, that is important to keep in mind when looking at charts like this?
Yeah, so when we look at charts, we have to look at a lot of things. And so, first blush, it's like, boy, oh boy, everything is down. And so a lot of times folks look at diversification and they say, I need to be diversified in my assets. And so they'll say, I need to hold 10 different individual stocks. That's being diversified. Or I need to have 5 or 8 or 10 different mutual funds, being diversified. I need to have some in stocks and some in bonds. I'm diversified. What sticks out to me is that whenever we have individuals or governments that control the majority of the wealth in the world, going in and interfering with how the free market actually operates, which is what happened during 2019, 20, and 21, that it really turns a lot of the economic paradigm totally upside down on its head. And so that's when you want to make sure you do a couple of things. Number one is you don't react emotionally. And even this last week, some wise older managers that some of you may have heard of, by the name of Warren Buffett, was actually talking in his annual shareholders meeting about long-term investing and making sure that you're not a trader, but that you're an investor, which means that when you look at quality companies, you look at quality indices, you look at quality mutual funds, and you say, I'm going to buy those and I'm going to own those. And they may go up in value or down in value, but you say they're high quality companies that we've analyzed, and we're going to actually invest. We're investors. We're not traders. We're investors. And if you're going to be a trader, then you would invest in things like GameStop on Robinhood or whatever it may be. And that's not played out so well for a lot of people. And so one of the key things that sticks out is this is a period of time of 4 months. And if your time horizon is 30 years, it's 4 months out of 30 years. And so I'd say number one is to make sure that you have the proper time horizon and that you're investing accordingly. But then secondarily, you also want to make sure that when you see a period of time like this where bonds are down and stocks are down, you want to ask some questions why, but also you want to make sure that you're responding with a proper time horizon and not emotionally. But it's interesting how we see here the Nasdaq's down 20%. So really, what drove the stock market, even the S&P 500? Over the last 3 years was really technology names. And so the S&P 500, there's 505 companies. The top 20% of those companies represent a very large percentage of the movement in the S&P 500. What really drove the outperformance within the S&P 500 is technology stocks. And so across the board, technology led higher, really the last couple of decades. Well, there come periods of time where it does lead lower, and that's what we're seeing right now in the first 4 months of the year.
Right. And so that's what we see from the indices, from the performance. And you alluded to government agencies or governments having a big impact and flipping some economic preconceived thought or beliefs on its head. And so we went through a period where for 2 years there was a very loose fiscal policy. A lot of money was pumped into the system to prop up the economy during the last 2 years. And now we are going into a period of high inflation, so interest rates are going to go up, and the Federal Reserve is going to be tightening or removing all of that liquidity from the system. And so, John, we've only ever seen one other period of something similar. It's called quantitative tightening, and it actually occurred back in 2017 through 2019. We'll put a nice chart up here on the screen for you guys to be able to see the visualization of what's happening here. The dark blue line, that's the S&P 500's performance over that time period, and the light blue line is actually the Federal Reserve's assets, or the number of bonds or mortgage-backed securities or other investments that they were holding on their balance sheet. And so what you see happening here is they're actually decreasing that amount. And so, John, whenever you look at something like this, can you provide some perspective from that past period of quantitative easing and then tightening and how it relates to today?
Yeah, I think one of the things to keep in mind is if we have 100 of the world's brightest economists in the room and we're all talking, you're going to find 110 different opinions as far as on what's happening in the economy and what to do and how to do it. And so there's all these different opinions of what to do with inflation. And so we do know the Federal Reserve did increase monetary supply. So whenever you do watch the Truth of presentation live, Andrew Updike do give really, I'm going to say, a college level explanation at a junior high level of explanation, a phenomenal job on monetary supply. and talking about monetary supply and getting dollars into the system and out of the system as a way of controlling inflation and also interest rates. And so right now, as far as in the economy, there's a huge discussion with the inflation that we're seeing. Is it transitory or is it more permanent? And if it is transitory, in other words, a short period of time, then you're going to manage things a little bit differently than if it's more of a permanent or a longer period of time. And so what we're seeing right now is what's called quantitative structuring, or the tool is quantitative easing. And so in other words, whenever we're putting dollars into the system, which is what happened in 2000, really ever since 2008 and 9, federal governments, not just U.S., but around the world, have been putting dollars into the system as ways of stimulating growth in the economy. Right now, when inflation is really running at rampant paces, they're having to slow things down. So in doing so, they're removing dollars from the system. And in doing so, that is something we have not seen a lot in the past. But whenever we do see that, it means we need to be considering how is this going to impact both stocks and bonds, but then also how will it impact other ways of diversifying your portfolio.
Right. And one of the big byproducts of that tightening period, when we look at the performance of the S&P, is there was a lot of volatility during those few years. Remember back in 2018, there was a couple of months there where the intraday movements in the market were very, very large. And me and you actually were talking earlier this week about how we've been noticing that as well, as a similar amount of volatility in the markets, just even within a 8-hour period. That is really kind of alluding to that interesting period that we're entering from an economic standpoint. And John, one of the things that we have talked about in the past is stagflation. You kind of gave us a high-level overview of that. But we've also talked about rules of thumb and how a rule of thumb is just a great starting point. But we each have individual situations and goals and investments, and we shouldn't be totally tied to a rule of thumb. Can you kind of walk us through how stagflation, inflation, rules of thumb, how they all tie together with what you were just talking about there?
Yeah. It's interesting times, and so typically, when we think about normal times, right, we have an economy that's just kind of moving along, people are finding jobs, and sure, there's always a certain level of unemployment. The economy grows at a decent pace, between 1.5% and 3% as far as in growth. Inflation sits at about a 2% rate as far as inflation. Prices of goods and stuff at the grocery store and all that going up at a certain level. And interest rates, they stay within a certain range. And so they may increase or decrease a small amount, but within a certain range. There's something out there called stagflation, and a lot of people are actually talking about, where do we go from here? And we have inflation, when the cost of goods and services going between a 7.5% and a 9.5% pace. If we have inflation, that would typically indicate that the economy is expanding rapidly. We have unemployment very low, and our economy is growing too fast, so it's overheating. Well, stagflation actually talks about whenever we have inflation at higher than normal rates, in some ways very, very fast rates of inflation like we're seeing right now, but the economy is actually slowing down, and so it's stagnating. And so it's a combination of stagnating in the economy as far as in growth, but also inflation being higher than normal. We saw in the first quarter of 2022, our GDP growth rate was actually a negative 1.5-ish%. That'll have to be readjusted here in the coming weeks, but so we actually had a contracting economy in the first quarter, and we had inflation going at very high paces. So whenever we see that, we talk about general operating environments. Whenever the economy is doing something, here's what to expect. But when things get flipped upside down, which usually happens by outside interference within the economic world, then what happens is the normal rules of thumb for how we invest and how we actually diversify need to be challenged or changed a bit because the environment has changed. And so that's really what we're seeing, is that we're seeing an unusual market in which things that would normally be right side up are kind of upside down. And so as an example, inflation at a very high pace and the economy contracting. So that's something we don't normally see, but whenever we do, it brings about different opportunities and also different risk along the way. Right. So in this environment, we have to be considering things a little bit differently when it comes to portfolio management.
Right, and one of those things is the 60-40 portfolio. 60% stocks, 40% bonds. Historically, it's been a very solid, lower risk investment for those who are either a few years from retirement or those who are in retirement. But so far, we are actually off to the worst start to a year for the 60-40 portfolio going back to 2008. And so we are definitely entering a period where some things have been flipped upside down, and you can't just take a rule of thumb, accept it as gospel truth, and move forward with it. You need to look at things critically and how they relate to where we are today. And so, John, that's something that we've been doing a lot of recently. We're looking at our toolbox, saying, hey, what are the things or tools that we need to help our clients face this environment and be able to achieve those big goals that they have? And how can we adjust their blueprint? And so, can you walk us through the Creeping Wealth Blueprint process? I know our clients are very familiar with it, but can you walk us through that?
Yeah.
And then also how we've been expanding that toolbox to help our clients achieve their goals?
Yeah, so we so appreciate feedback from everybody as far as the tools we have, the technology that we use, the different available investments inside portfolios, and how that is actually growing and changing, or services that actually help folks accomplish their financial objectives. And whenever we're in a time where things are challenging, when the U.S. government bonds are down 10% year to date, corporates down 12 or whatever it may be, and stock markets down between 8 and 20%. We have to say, what are other ways we can improve our financial situation to give us a great foundation? So there's a couple things that we're doing, Drew. Some I think is process, some is service offerings, and then other is actual tools inside your investment portfolios. So from a process standpoint, we are going to be rolling out here we're beta testing right now, rolling out to all of our clients, and actually a new tool. And this new tool comes from feedback from all of you about, I want to know where I'm at in accomplishing my goals, but I also want to know my daily activities. What are things that I can be doing to improve my daily activities? So an example might be, I'm heading toward retirement. I'm not sure what to base my spending on. Help me understand that. So we would have a simple tool that can integrate with your checking account and also with your credit and debit cards, which shows you what your burn rate is of the cash that you receive every month in income. Well, that gives you a baseline then for how much income you're going to need in retirement, or you're trying to save for college, or you're trying to actually just getting started, you're just out of school and you have college debts, how to pay them off. Well, we wanted to have a tool which helps you make those small micro decisions to give you more information. So that's a tool you have been requesting that we brought in play. But then also additional services, ways to find, if we're having trouble as far as with having a rate of return because of what's happening with interest rates and quantitative easing, and with the federal government's being involved there, so bond rates are lower, and the stock market's also upside down because of what's happening with interest rates. Well, then all of a sudden it's like we need to find other ways to save money. And so with that, we're bringing on some additional resources and professionals to help us as far as on things like tax planning. So not tax preparation, but tax planning, ways to decrease taxes as far as that we're paying every single year. So those are some of the tools and some of the processes we're bringing on. And be looking for inside emails and announcements and other video messages we'll be sending out here the next couple of months to highlight those. But we're also adjusting the tools that we're using inside of portfolios. And so as Drew really kind of walked through, and I linked to an article as far as in the 60/40 portfolio, not performing well. I mean, it's the worst start for the year, down, goodness, around 9-10% start for the year on a conservative portfolio. If you use the 60/40 mix, which is what's recommended by the academic experts in financial planning, well, that's just not good enough. And so we need to be able to adjust and adapt to the changed economic environment. So there's some tools that maybe in the past we would not have considered because they were out of favor for that season. Well, right now, there are ways of decreasing risk. We don't have principal loss, or we could increase the yield you're receiving in that 5 to 6.5% range for our dividend demanding clients, and ways to actually have growth in portfolios when markets are down. So rolling out a lot of new tools to utilize within portfolios to drive some risk lower and to increase what we call alpha, or rate of return, for the risk that we're receiving.
And so we'll provide more updates as we go along there. Some of you, we've probably talked about one of the initial Wave 1 tools that we've actually been using now for, John, how long have you been doing the target outcomes? Probably 18 plus months?
Yeah, about 18 months.
Yeah, so we'll put a chart up here to show performance. I mean, year to date, these investments have done exactly what we expected them to do in this environment. So the purple and the orange line, those are those buffer or target outcome ETFs. We talked about them in past videos and probably in client meetings with you. But you can see so far this year, they're outperforming both the U.S. Aggregate Bond Index and the S&P 500 handily. And as long as you continue to hold those, the way those funds are structured internally, your performance will be solid throughout time. They're going to fulfill the function that we expected of reducing volatility on the downside, but providing a much better upside potential return than bonds in this environment. So that was the first tool that we rolled out, and we have other tools that we're working on in various phases of readiness, and so you will be made aware of that as soon as we are ready to roll with that.
And Drew, I'm so excited about some of those tools that are coming out. I mean, we have a lot of clients that have been holding some really solid names in the individual stock world, Apple, Nvidia, Amazon, with tremendous capital gains there. We want to hold, so let's find ways to generate using different option writing strategies with different professional managers of preserving some downside, but also getting some yield off of those. In addition to bringing some really high quality managers and some alternative space into portfolios, some private equity, which is a phenomenal space to bring about stability, and also just some higher alternative income producing tools that will really balance out portfolios. So more information to come on all that, guys, but it's a way of saying let's recognize the whole paradigm has shifted.
Yep, absolutely, absolutely. So we'll follow up with you as we need to, and once we are ready to roll out with those big new upgrades. So John, what is something that you could just wrap up for us here? We've covered a ton of ground, some of it good, some of it not so good because of where we're at. So what would you sum up for us with one thing to move forward into the week with?
I'll tell you, the one thing to keep in mind is that the world is always changing. And we know as things change is not always easy. As a matter of fact, sometimes it's kind of challenging to walk through it. But whenever we see the economy changing, we see the world changing, and some of the typical rules we could count on in the past, for this season, they're not quite working the same as they always have in the past. Because the economy's changed and we have outside influence. So I'd say the number one thing is you want to be focused on the long term. We want to say it's a season, it's a journey, a season of the journey. It's part of the path that we're on. But we're going to navigate and find ways to get through it. Have a long-term perspective. Let's make strategic long-term decisions that help you accomplish those goals and live the life you always want to live.
Yep. And if you're looking for other sources of truth, like we talked about, we have the link to the Truth Live video. We are also going to include a link to financialtruthmedia.com. It's a website that we put together to house a lot of resources our team has been working on for you to download and to read to provide more education points for you. So we would encourage you to check those out. If you have any questions or want to talk about, hey, what do we need to do to make sure my portfolio or my plan's in the right place, absolutely reach out, schedule a 15-minute strategy session with your advisor, and we'd love to chat with you. Thanks, guys. Have a good one.